Up to 85% of your Social Security benefit can be taxed. And here's the part almost nobody is told: the income line that decides it hasn't moved since 1983. Not for inflation. Not once. Which means every single year, a little more of the middle class gets quietly pulled into a tax that was originally designed for the wealthy. There's even a specific point where pulling $1,000 out of your retirement account can create $1,850 of taxable income. Financial planners have a name for this hidden zone. They call it the tax torpedo. By the end of this video, you'll know exactly where it hides, why your real tax rate can be far higher than the bracket you think you're in, and which kinds of income set it off. Start with how Social Security even becomes taxable, because the rule is stranger than most people expect. The IRS doesn't simply look at your salary or your pension. It uses a special figure called combined income, sometimes called provisional income. And the formula is very specific: your adjusted gross income, plus any tax-exempt interest, plus 1/2 of your Social Security benefit. Read that middle piece again: tax-exempt interest. Even income that's supposed to be tax-free still gets counted here. And the half of your benefit piece catches people too, because your benefit helps decide how much of your benefit gets taxed. It's circular by design. That single number, combined income, is the gateway that decides everything that follows. Once you have that combined income figure, it runs through 2 thresholds that create 3 tiers. For a single filer in 2026, below $25,000, none of your benefit is taxed. Between $25,000 and $34,000, up to 50% can be taxed. Above $34,000, up to 85% can be taxed. For a married couple filing jointly, the same tiers apply at $32,000 and $44,000. 85% is the ceiling. At least 15% of your benefit is always tax-free, no matter how high your income climbs. But notice how low those entry points are. $25,000 of combined income for a single person is not a wealthy retiree. It's an average one. And the reason those numbers feel so low is the first trap. Look at those thresholds again: $25,000 and $34,000. Here's what almost no one realizes: they were set in 1983, with the upper tier added in 1993, and they have never once been adjusted for inflation. Not in over 40 years. Think about what that does. In 1983, those thresholds were high enough that only relatively wealthy retirees ever paid tax on their benefits. But everything else has inflated since then: wages, the cost of living, home prices, and Social Security benefits themselves, which rise every year with the cost of living adjustment. The threshold stood frozen while the entire economy grew around them. So each year, the cost of living raise that's supposed to help you can quietly push your combined income over a line that hasn't moved in 4 decades. A couple receiving an average benefit, plus a modest pension or a small withdrawal, now routinely lands in taxable territory, something that was never the intent when the rule was written. It's a tax that expands automatically every year, without a single new vote, simply because the line stands still while everything else moves. When the rule was written in the 80s, fewer than 1 in 10 beneficiaries owed any tax on their benefits at all. Today, the majority do. Nothing in the law changed to make that happen, only the frozen numbers and the passage of time. That's the quiet power of a threshold that never moves. It doesn't have to be raised to reach more people. It just has to stay still. And once you're inside the phase-in zone, the second trap is waiting, and it can be far more expensive than the first. This is the part that gives the tax torpedo its name. Inside that phase-in zone, every extra dollar of income does 2 things at once. It gets taxed itself, and it can drag more of your Social Security benefit into taxable income right alongside it. Let me show you the math, then make it concrete. Say you're a single filer collecting a $30,000 benefit, and you take an extra $1,000 out of your IRA. That $1,000 raises your combined income, which in turn pulls another $850 of your benefit into taxable income. So you've now created $1,850 of taxable income for $1,000 of actual withdrawal. If you think you're in the 12% bracket, your real rate isn't 12%, it's 12 times 1.85, about 22%. And in the 22% bracket, the same arithmetic can push your effective rate north of 40%. Now picture a real couple. Illustrative example, not financial advice. $25,000 in pension, $1,000 in interest, $500 in tax-free municipal interest, a $10,000 IRA withdrawal, and $50,000 in Social Security. Add the income plus half the benefit, and their combined income lands at $61,500, well past the $44,000 threshold. Result: up to 85% of their benefit becomes taxable. Roughly $20,000 of the Social Security they earned over a lifetime now shows up as taxable income. The rate spikes through this zone and then settles once 85% is fully taxed. It's a hump in the road that almost no one sees because nothing on the tax form is labeled Torpedo. And the income that triggers it can include money you assumed was invisible. Go back to that formula one more time. Adjusted gross income plus tax-exempt interest plus half your benefit. That tax-exempt piece trips people constantly. Interest from municipal bonds, the income that never shows up as taxable on your 1040, still gets added straight back into this calculation. So a retiree who deliberately bought tax-free municipal bonds to keep their taxes down can discover those very bonds are pushing more of their Social Security into taxation. The income was tax-free for one purpose and fully counted for another. And it isn't just muni interest. Required minimum distributions from traditional accounts, capital gains from selling an investment, part-time wages, a Roth conversion. Every one of them raises combined income, and any of them can move you up the tiers or deeper into the torpedo zone. This is why the trap so often springs in the years people least expect it. The year an RMD kicks in, the year a home is sold, the year a one-time gain lands. Imagine someone who has carefully kept their income low for years, paying little or nothing on their benefits. Then they reach the age, around 73, when required minimum distributions begin, and the IRS forces a withdrawal whether they need the money or not. That single forced withdrawal can be the exact thing that tips them over the line, in a year they never chose. None of these pieces looks dangerous on its own. It's how they stack against a frozen threshold, through a spiking rate, counting income you thought was off the books, that turns an ordinary year into an expensive one. So what can you actually take from this, stated plainly, and none of it personalized advice? First, the formula is public. Combined income equals AGI plus tax-exempt interest plus half your benefit. Knowing that number and watching where it sits relative to the thresholds is the single most useful fact most people are missing. Second, not every dollar of income affects it the same way. The rules treat sources differently. For example, qualified withdrawals from a Roth account generally do not count toward provisional income at all. That's a documented feature of how those accounts work, not a recommendation about what you should do. There are also documented tools that reduce the income this calculation counts. A qualified charitable distribution, for instance, lets certain retirees send money straight from an IRA to a charity without it ever raising adjusted gross income, which means it never feeds the combined income figure. A health savings account can serve as another source of funds that doesn't add to it. Again, these are features written into the rules, not instructions for your situation. Third, there's a geographic layer most people forget. As of 2026, only around 8 states still tax Social Security benefits at the state level. Most don't, but a handful do, so where you live can change the result. And fourth, the IRS publishes a worksheet that calculates exactly how much of your benefit is taxable. It's the authoritative source, not a rule of thumb from a video. What none of this is guidance about your own withdrawals, your own conversions, or your own filing. Those depend on your full picture and belong with a qualified professional. What Greyrock does is show you the rule, the number, and the source, so you can ask the right question before the torpedo hits, not after. If the idea that a frozen 1983 threshold is quietly taxing your benefit caught you off guard, that's exactly the point. It was built to be invisible. So here's a quick one. Did this catch you off guard? Comment Torpedo below. I read them. And this is part of a series on the tax traps that hit retirees hardest. The one most people trigger without realizing, The Medicare surcharge, where a single dollar can cost you $487 a month, is on screen now. Watch that one next.